Elon Musk is the first one to say the first prototype is the easy part. The hard part is the production, where you need to scale 1,000 times and then everything blows up.
Anyone can do anything in the lab. Now, when you scale, you don't scale just the good things. You scale also the bad things. So those bends, those cracks, those losses that you had in the process in 1%, well, in the lab, it's fine. But if you scale, then that can make the entire process not commercially viable. Before the 90s, VCs were doing only hardware. The software game kind of started all of a sudden with the show up of the internet. If you are managing to pull in more power into the chip industry, and we see now NVIDIA, then there is a gigantic market waiting for you. This is everything that VC is about.
Welcome to the Climate Insiders podcast, where top climate thinkers, entrepreneurs, and investors share revolutionary ideas and insights. Tune in to learn from the visionaries shaping a sustainable future. Let's dive in. Yair, welcome to Climate Insiders.
Thank you, and thank you for having me in your lovely living room.
Thank you. My great pleasure. And so today it's fucking awesome. So I'm glad that you're representing. Cheers to that.
Cheers.
And so we're going to talk a lot about FOAK. We're going to talk about cap tables, about how to make companies bankable. There's a lot of great topics. You're a fellow content creator, so also we can talk about brand building. There's a lot of things to derive. So first of all, what is the fucking awesome? Just explain us, where did that come from? Is that a marketing stunt? Has it worked very well for you and Extantia?
Well, you know, we spend a lot of time already for a couple of years with the topic of FOAK, right? And the reason being that if you look at the second wave of climate tech or clean tech 2.0, right? I mean, when it started 2000 after Paris Climate Conference, when it really picked off in 2018, 2019, those nascent companies arrived maturity around 2 years ago. And all of a sudden, they started building stuff. And we started feeling that there is a recurring topic among our companies. Okay, how do you finance this new thing? We didn't think about the word first of a kind yet, but people started talking about it, and it became a thing, and we started doing things around it, and basically writing about first of a kind. And all of a sudden, it picked up, became a topic of its own, and therefore, for us, it was important to make sure that it stays like that, and it stays on top of things, and therefore, going to all these events and being on podcasts or on stage in events, I was thinking together with all of us, well, we want to bring it across that this is really, really great. And we were playing with the idea, and that's how we came up with this fucking awesome. And we said, oh, actually, we need a t-shirt.
You're a startup after all.
Exactly. So we printed out to one of our all hands events, actually. So internal gig, posted it on LinkedIn, and all of a sudden we started receiving orders.
How many orders did you get?
I think we passed now the 200 or something. So
is it mainly for investors or startups?
It's everywhere.
Everywhere.
It's investors, it's startups, it's our competitors, it's everybody. I mean, I think it's just everybody's dealing with it every day. And it's a topic that unites both the founders from what they struggle, but also the investors from their perspective. And we talk about that, why we think that taking the FOAK risk is so great. But
all right, well, let's speak about this. So FOAK, first of a kind, and you kind of coined that term. And so what does that mean in your eyes, and why should people care more?
Well, it's a very good question to start with, because actually, you know, everybody is talking about it, but the first question is what is a first of a kind? Everybody tells you, I'm doing first of a kind. Well, not really. Well, first of a kind, it means that it's a first of a kind, right? So the meaning that it has to be something that you do for the first time in a certain setup. You either have a new technology or you business or pieces of technologies that you bring together for the first time. So that's maybe the first element. The second is that it's of a kind, right? Then later comes the nth of a kind. So it has to be part of a series. Now, that means that it's going to be duplicated in a way. If it's not going to be duplicated, it's not first of a kind. It's a pilot, it's a demonstration, but it's not a first of in a series of more stuff that is going to be. Now, it doesn't have to be that it's exactly the same scale of your commercialization factory, but it has to have all the elements. So when you do your first commercialization, it's not the first, it's the second. So that means that, for example, maybe the scale, for example, is 1 to 10. So if you're using reactors, bioreactors, then it's not that you did in the first of a kind, you did 5 liters, and now in the real one, you do 50 liters. No, in both of them, you do 50 liters, but in the second one, in the scale one, you do just 10 times 50 liters. So basically, all the processes, everything that I can learn of the kind is already demonstrated in the first one. Because otherwise, it's just another step in demonstration, but it's not the first one in a series of
and the
others.
Real complexity is that if you're an nth of a kind, the second, the third, a bank will show up, a private equity fund will show up and be able to finance something because it's already been demonstrated. You know your metrics, you know the financials, but the first time, no one wants to. They're all scared of risk. So this is where VCs have a role to play. It's a very particular window of opportunity. And so you're saying that as VCs, we should take more risk going into first-of-a-kind financing. Have you seen great success stories? Could you share maybe, off the top of your head, a great success story? Do we have evidence that it's worth the risk?
For sure, we have evidence all over the place. I mean, even if we have not necessarily in our portfolio, but I can give you examples later as well. Take a look at H2 Green Steel. I mean, a company that is doing putting technology pieces together to create the first time in the world, actually, a DRI plant that steel production, iron ore reduction plant that is using, instead of gray hydrogen, is using green hydrogen. That has not been done before. Everything else has been done before, but the green hydrogen element has not been done. So they're putting all these pieces together and are managing to put offtake agreements and finance this thing. And by doing so, their valuation of the company is exponentially growing. So basically betting on the first of a kind, if you manage to pull it off, you're showing that not just that the technology is de-risked, but your ability to execute is de-risked.
Looking to make smart investments in climate tech? Subscribe to the Saturday Climate Insider newsletter. Every Saturday, I'll send you one actionable tip to navigate the climate tech investment landscape. Join over 3,500 investors who are already gaining exclusive insights and strategies. Subscribe today. All right, so green steel. What are the other sectors where you see obvious first-of-a-kind opportunities?
Sustainable aviation fuel. Right? I mean, we have Ineratech in our portfolio that is putting together now building a plant for sustainable aviation fuel in Frankfurt. Once this is done, it's a completely different game that the company is. I mean, this is we think that taking a FOAK risk is where VCs today can return a fund.
Which is somewhat contrarian to think. Historically, VCs have made money on software where there's a clear path to market, where you have an MRR, right, a monthly recurring revenue. So you're making projections as to how that can evolve with a bit more VC fuel. So here you have no evidence, but you're saying this is where the multiple will be accumulated with the uncertain timeline.
I think that most of us are too young so our perspective is a little bit too short. Before the 90s, VCs were doing only hardware.
It's true.
The software game kind of started all of a sudden with the show up of the internet. But Silicon Valley is called Silicon Valley, not because it was done. The S is not for software valley.
So for a good reason.
For a good reason. So basically, with hardware, there are VC returns to be made. This is usually in hardware. What is interesting is that, and it goes back to the FOAK, but not just that. If you solve these technological problems, there is by definition a gigantic market to be taken. If you are, what was the origin? I mean, if you were looking at the silicon, at the chips industry, right? I mean, if you are managing to pull in more power into the chip industry, and we see now NVIDIA, then there is a gigantic market waiting for you. Mm-hmm. This is everything that is VC is about.
Oh, I'm so glad that you bring NVIDIA. NVIDIA is the ultimate proof point that you can build a picks and shovels or hardware play. I mean, all they do is building chips to enable the AI revolution. Right. They're not building an algorithm. And they are yet now the second largest market cap in the world, right? They're ahead of Apple, ahead of Facebook, ahead of Amazon, which is unbelievable. And so NVIDIA is our go-to. We are building the NVIDIAs of the world that will be the enablers of the entire industries of tomorrow.
Definitely. I think there are companies that are making the wave, and there are companies that are enabling the wave, right? But it's not like you can only make money with one and not the other.
Right. And another question that we get a lot is, first of a kind, does that include nuclear fusion, in your opinion? Something that has not been cracked, where there's a significant R&D risk. So it's not just about building a factory, it's building about the entire tech around it.
Again, first of a kind, these are now interpretations of the term. First of a kind is when you build something that works,
okay,
and you can generalize from that towards the nth of a kind. I think that in fusion today, we're still in building the labs.
Okay. So we are coining it in terms of TRL, so technology readiness level 1 to 9. Where are we in terms of TRL, in your opinion?
8.
So TRL 8. So we already passed lab, proven in its actual environment.
Right.
Ready to be shipped. Okay.
Exactly. Basically, the only thing that is not there yet is the scale.
Right.
But everything else, it is being demonstrated in the actual environment. It's being demonstrated as the entire value chain. It can be the processes. I mean, chemical processes are tough to scale, right? And they don't. And maybe I'll say something on scale in a second. But therefore, it has to be that this can be proven, that the next step can be taken.
Great.
This is TRL 8.
TRL 8. And in terms of stage of funding, you're not going after a pre-seed company that is still, trying to demonstrate its tech. You already had a Series A, most likely, or Series B. Do you think there's a correlation between the stage of the company and then building the first factory?
I think there is no correlation between the TRL of the company and the letter of the series. We see great companies that are, because there is a lot of R&D grant money, that are staying longer in universities. Mm-hmm. And at the time that they are spinning out and raising the first capital, they are already very advanced. For example, when we invested in Reverian, they were just spinned out from university. They were 6+ already.
Mm-hmm. I love it that you're trying to sexify the space, because we need new angles of attack, right? New narratives. We need to tell new stories. So let's make it sexier. And another unexpected sexy factor or actor rather are strategic investors, corporates. They always use historically, and this is not just software, but it's been the case in hardware. There's always been the fact of David and Goliath. David is the startup trying to disrupt a new industry, trying to innovate, when the incumbents are trying to slow things down, right? They're dominating a space. There's no incentive for them to transform the industry. And yet, here in climate tech, we're seeing that there's almost no way around leveraging the incumbent as a strategic. Do you think, are you advising all your startup companies, and then when you assess a portfolio or a potential investment, there needs to be a path where they need to strike an agreement with a corporate to scale?
Let's Yes, but let me take a step back. There is a lot of discussion about offtake agreements and how startups should get offtake agreements, and it's going to be nice to have offtake agreements if they want to. It's like nice to have if you want to build a FOAK. It's going to be nice if you're going to have offtake agreements because then you don't need equity, a lot of equity, and you can have bank financing. This is not the right way to talk about it. Offtake agreements are not a nice to have for any hardware startup, especially in climate tech. Let's think about the software industry. In the software industry, if you have a Series B company, you're not going to finance that company if it doesn't have ARR. So in climate tech, we will not finance any company if it doesn't have offtake agreements. Okay. Offtake agreements are the ARR of software, meaning at the end of the day, you have to generate revenue. And if you don't know how to generate revenue, then you don't have the merits and the right of existence as a startup. Full stop.
So it's an ARR of hardware companies.
The ARR of hardware companies is offtake agreements.
Great. So
now, who are the customers? Who are the off-takers? The off-takers are strategics. And therefore, you have to work with the strategics and very early on. And one way to go about it is add them to the cap table.
When should they add them to the cap table? We often see conflicting signals there. You should not have them too early because they might corrupt the growth. They might also try to scoop an early acquisition and then try to make it very attractive for them, but not too late because you will already be too big. So when is a sweet spot?
If you want a short answer, probably Series A. Mm-hmm. That's probably a good time. What is important is that it's not an overkill for you, that you know how to onboard them, and they come with a lot of demands, even within their, procurement policy that you need to adopt yourself. It's a big manual that you need to adopt. So all these overhead things that you know how to do that. But at the same time, it's important that you have the capacity. Capacity means time and attention to work with them and leverage them for the stuff that you need. Because otherwise, you're going to onboard them, but you're doing a lot of stuff yourself and you don't have the time to work with the corporate. And that is requiring attention.
Does that mean that when you assess a startup, you need to have in the team someone who already has the network to corporates? Or is it the value add of VCs, like Extantia, to bring a wide network of strategic and then to cherry pick them based on the particular technology?
It's both. I think that we look up to VCs to help companies, and we do what we can. But at the same time, companies need to do stuff, and founders need to do stuff. Cannot rely only on the VCs. Maybe that's a good time to announce also that we've created a new full-time position in Extantia of a person that is now our head of offtakes and partnerships.
Well, it's good that you're the shameless plug. That's great. And so is that a new... I'm fascinated by the evolution of the VC space and see, for example, chief sustainability officers didn't exist.
Right.
Now, head of offtake agreements. Well, you're basically coining a new term here, but it's essentially a corporate a partnership or a customer success manager, if you will, but at the climate tech sauce.
Correct. We were thinking about the title, whether it should be head of commercialization or whatever, biz dev. But at the end of the day, it's important that people understand what it is about. And in our case, if you were a startup in software, you would have chief revenue officer, right? And if you're a climate tech company, you should have a chief offtake officer.
Right. What about chief FOAK officer?
A chief folk officer, by all means. That is what we call either the project manager or chief engineer, but it's definitely someone that it knows how to work with EPC companies and how to build projects. The challenge that we have, or the basically, we're asking founders in climate tech something impossible. If we look at software, basically we're asking two things from founders. They need to be great coders. So they need to know what, if they are coming and doing something in cybersecurity, they need to know something about cybersecurity, right? And they need to get to be great business people because they need to sell that. In climate, we're asking actually three things from founders. One is, of course, okay, they need to be great science people. That is the equivalent. So they need to come with great innovations. They need to have this business acumen, right? So they need to know how to do offtake agreements and things like that. But at the same time, they need to be great engineers. And this is a completely different for science people. Science people are not engineers. But at the same time, scaling and bringing things to market, innovation to the market, that is what it's all about.
Can you expand on the difference for you, a deep tech engineer and a software engineer? You're saying that software coders are not engineers.
I'm not saying they're not engineers. I'm saying that the science people are not engineers. And I'll give an example. So basically, anyone can do anything in the lab, right? I mean, you can come up with a process that is working in the lab and you can generate green hydrogen in great efficiency in grams a day. Now, the challenge is that it might be that things are, there are some losses in the process, there are some bends in the reactor. Now, when you scale, you don't scale just the good things. You scale also the bad things. So those bends, those cracks, those losses that you had in the process in 1%, well, in the lab, it's fine. But if you scale, then that can make the entire process not commercially viable. So when we're talking about grams a day, the reality out there is tons an hour. That is not an order of magnitude. That's not 2 orders of magnitude. This is 3-4 orders of magnitude bigger. Right. And that's when things start to crack. Yeah?
Right. I'm glad you mentioned this. Elon Musk is the first one to say the first prototype is the easy part. The hard part is the production, where you need to scale 1,000 times and then everything blows up, right?
I mean, if you look at a car company, it's everybody can build a car. That's not the challenge. But to get into serial production and make sure that all the parts are on time and get it out of the factory with the quality and the right price point, that's what's difficult.
Great. So that, I'm glad that you mentioned this. So now, how do we make, continuing on that narrative of making it sexy, what makes a really sexy climate tech hardware company in the eye of a financier, right? Of a bank or the big financial players? Is it something novel, a blue ocean field, or on the contrary, something boring that has predictability? So as soon as you have a VC financing FOAK, it is predictable. It is more likely to appeal to the big financial players.
Well, it depends on who you talk, right? I mean, VCs, we like sexy. Banks, they like boring. So, because VCs were all about upside, right? I mean, this is going to be gigantic and right. I may lose my money, but I'm going to have IRR is going to be 30%, et cetera, et cetera. Banks are not like that. Banks are all about the downside. Banks are, I only care about cash flow. I want my money back and I want my, let's say, 6% interest. That's it. I'm not thinking big. So that's why it's by definition that VCs are from one planet and the banks are from another. And we don't talk the same English.
Right. I'm also glad that you said that inviting strategics to your cap table is a good idea. That's something that can enable scale and then align the stars, the incentives, so that they are best positioned to potentially acquire the tech, which will then help diffuse it globally in their global network.
Right.
But there's also a number of, you're great with this on LinkedIn, illustrating the cap table mistakes to avoid, right? Very early stage. Can we enumerate some of them? So I can start, for example, having too many line items, too many small angels to a cap table is a bad idea. It scares away the VCs. They like a clean cap table. What are the other mistakes that are recurring?
Look, I would say that the recurring problem is that we're all thinking too local, meaning we are doing local optimization rather than global optimization. So when a founder, and basically you're always taking the right decision. It's not like founders are making mistakes. They are in a certain position, in a certain point, and they have to take a decision. Way of an example. You're about to spin out a technology out of university. University says either you give us a 30% stake in the company or we don't give you the IP. Now, you're as a founder, you think, what should I do? Either I sign or I'm dead, right? So you go with the 30%. Or if you're a founder and you're running out of cash and someone coming and offering you, okay, I'll give you cash, but I want 50% of the company.
What is the alternative, though? Should you be strong and say, no, this will kill the long-term possibility and potential of this company? I will never tolerate this. This is crossing the line. Or if you're in the shoes of the founder, broke, and then really with internal mode where they don't really have much perspective beyond a couple of months.
I have a very clear answer. Being dead fast is better than being dead slow.
Fail fast, succeed faster. Okay.
It's look, I've seen in my life so many zombies. It's not helpful. And that's why I'm saying don't do local optimization. Because local optimization is, and I mean, sometimes the decisions are correct, right? I mean, they're also good for the long run. But those types of decisions that you make now out of lack of other options, they're going to hunt you down and they're going to shoot you down later on down the road. And we spend a lot of time looking at companies that mistakes, in retrospect, mistakes have been done before, and now you need to undo them. And you know the second law of thermodynamics. So the chaos is just growing bigger, and undoing chaos is practically impossible, or not without a lot of energy. And if you have the text people breathing up your neck, then it's problem. Sometimes even you cannot undo stuff. So therefore, sometimes you just cannot undo mistakes.
Can we take an example? I have a perfect example off the top of my head where you had a lead seed investor that takes majority or close to majority ownership, and then the technology is brilliant. The founders are really smart. Then come at Series A new set of investors, but the seed investor has the majority ownership and wants his pro rata rights. So it's certainly a story between investors where it's completely eluding in the equation the founders and then the tech and then the potential of the mistake. So it's very, very much of a fight. And that happens very often.
Right. I'll give you another example of a good example, right? It's 2022, it's heydays, or maybe it's 2024, yeah? Someone comes to you and offers you a dream valuation, right? It's now... you thought you're going to be, 10 pre, and someone comes and tell you 50 million pre. I mean, you should take it. You avoid a dilution, right? You should take it. You should run for it, right? The answer is not necessarily, right? because the next financing round is going to come, and the next set of investors maybe are not going to be so benevolent as that investor. And if you didn't grow into that valuation, then all of a sudden, there is going to be a lot of discussion that the next round is not going to meet your expectations and previous investors' expectations.
Right.
And then all of a sudden, you have to talk about down round, and that starts a lot of discussion.
Right.
And this also happens a lot, and especially these days because
of the volatility of the last couple of years. And you and I know some of the funds that were particularly known in the space to set extremely high valuations, and then which undermines the founders, because then it's a very uncomfortable situation to tell the previous investors, by the way, your shares are going to be worth half of what they were worth a year ago. It doesn't mean that the company is dead. It doesn't mean it's not bad for the future of the company. It's just a valley. And sometimes those investors, out of ego and maybe to protect their shares, blocking the situation. They're really acting against really the benefit of the companies.
Ego is the biggest impediment for success. People need to write down stuff it's all paper money either way, right? But if you ask people to write down, it's somewhere in the ego, and you report it to your LPs that it's up, and now you need to undo stuff and rebook things.
It is all unrealized, and It is true. It's true that we should set maybe the ego aside until things become more real, which in the climate tech space, most of it will come in the next
But that's
5-7
how
years.
a lot of the stuff that we do on the way is really affecting the next steps on the journey for success. And that's why it's not like necessarily that someone was doing evil and taking majority ownership and but screwing up the founders and behaving badly, and all of a sudden, it might have been that that person was very generous to the founders, and it still may result in a bad outcome. So striking the right balance over the story of the equity story of the company is super important.
Another cap table mistake that I've seen. This is a recurring one. This is not specific to climate tech, but as more venture studios and venture builders spinning off, they tend to abuse on the terms early on, right? So we have a new generation of venture builders that understand that and do not undermine the founders by taking more than 20%. I would say that 20% for me is the cut, where it's at pre-seed, or you take a non-dilutive share of more than 20%. That will make conversations very difficult later on with VCs.
I think that generally the model of a venture studio is a very difficult one. There are a lot of difficult stuff out there, but this is yet another one. It's challenging. It's very hard enough to build one really successful company, and then doing it on a recurring basis. Marrying great ideas with great founders and have a pipeline of great ideas and a pipeline of great founders so you can launch one every year, it's very challenging. But then, therefore, they need their ownership in order to justify all the others.
There's a number of unspoken rules at the moment. I remember a couple years ago, it was common practice for a huge lead investor, a big name, to an index or a breakthrough energy to take the entirety of the round. But now we rarely see that. They would rather co-invest with a range of different investors. Do you have any common practice or advice to make to the founders? It's better to diversify, to have a broader set of investors. If you have a round of 4 to 5 million as a Series A, you would rather take 4 of co-leads that put in $1 million each, or would you rather have a big fund that you're going to collaborate with more closely because they have more ownership of the business? Enjoying the podcast? Make sure you don't miss an episode by subscribing to our YouTube channel. Click the subscribe button now and stay updated with the latest in climate innovation.
you have to strike a balance. It's neither that nor that. So I strongly believe in the power of syndication, and research has shown that the power of syndication, because there are not just more capital around the table if things are going south, but also there is more knowledge, there is more network and people that can help, right? So on that end, I would say, increase the amount of participants.
Mm-hmm.
At the same time, it's important not to increase too much and limit the amount of participants and not divide 4 million into 4 times 1, because you have to make sure that the investment is meaningful for that investor. If you end up having 4 investors, instead each having 5% of the company, instead of one having 20% of the company, that investment and the potential return of that investment is going to be negligible for each one of those investors. So at the end of the day, you were hoping to gain and build up on all the network and advantages that those guys can bring you, but why should they care? If I put $1 million, I almost write it and I get 5%, that's nice. But the big question is it going to return my fund?
Mm-hmm.
Is it going to be meaningful? So how much time should I spend over there versus where I spend 4 million and took 20% of the round, of the company? So that is the balance that one needs to strike. And therefore, I would say never give all the round to one investor, but also don't slice and dice the round between different investors. You have to have a very significant owner of the round that takes enough ownership and is the major lead. And then it's great to have follow-on investors. And by the way, for us, we do the mix. We have rounds where we're the lead, and there are rounds where we're the followers.
What I'd like to see with Extantia, and you're one of the few, let's just be honest, that is willing to take enormous risk on unknown territories and staying true to the power law. The power law is the portfolio, 90% of it will be zombies. By the way, we can come back to your definition of zombies. But there's a handful, 1, 2, 3 maybe in the front one or the entirety of the round of the fund that will be enormous performers. And you got to take risk. You got to skew the risk to the extreme in order to find them. And right now we're observing the opposite. And it frustrates me a little bit because the VC should be the one taking the massive risk taker. And I do not know if it's coming from LPs, from people at the top calling the shots and saying, we got to de-risk. We got to take a chill pill now because there's uncertainty on the market, on the interest rates, on the exit markets, whether it's going to be in 7 years, in 15 years. Why would you tell the rest of the fund managers in the space so that they, again, go back to the risk? Because that is the real role that we have to play.
I cannot jump into the brain of my fellow VCs. I can only say the following. VC is a tough work. You're working against the odds. Creating VC returns 3x on the fund is extremely difficult. And actually, we all know the mathematics. If you go for lower amount of funds, let's say 50 million, you're more likely to return 3x. If you go up, you need bigger exits. Actually, it's less easy. But at 50 million, management fee, etc., is low, so you cannot have the team, right? So we know all that. But what does it mean in life? What does it mean in terms of the investments that we're making? It means that we cannot invest in stuff that is the average. And VCs are a little bit herds. And we like to invest where we're all human, yeah? Me included, when I'm turned on is when I see that someone else is interested.
Right.
Why are they interested, right?
Or you desire what the others have, and et cetera, et cetera.
Exactly. So we're all doing that. But at the end of the day, when you create real returns, is if you're investing in a contrarian way, is where you're investing where others are not thinking at the moment to invest. That's when you can have valuations are lower. That's when you can have more ownership. And if you're right, you're going to strike it big time. But if you're going to invest where everybody else is investing, your ownership is going to be very little. And therefore, even if it's a great outcome, you're going to get very little.
How can we leverage our platform to an audience? Because you're also a LinkedIn influencer as a top voice to help spread those very important fundamentals. Let's go back to the first principles of VC. I'm glad that you're stating them. Do you first of all, do you share the same view that now that we're in a bit of an uncertain territory, we lower down the risk, we're dialing down that risk exposure, and what can we do about it?
So let me answer about the creation and the branding element. I don't know if you would believe me that I would tell you that I'm an introvert. Yeah.
Me too. High five.
But we do all these things that are exposing ourselves that are not in our comfort zone.
Fully agree.
But in order to be successful, you have to go and be out there. And we tell that to our companies all the time, and we have to walk the talk ourselves as well. Because if our companies, and this is true in everything, if you are doing something right, if you're onto something, more will come. There will be competition. Yeah, and if you don't see the competition today, it will come later. A good market is where there is more competition. So if there is no competition, you're doing something wrong. But at the end of the day, when the competition comes, what is it that is going to differentiate you to the competition? And sometimes it's the product. Then you're going to have something, yeah? So you're going to have on the features. But most of the time, at the end of the day, it's going to boil down to the brand.
The brand. And so you've consciously put on a lot of effort. Was it a conscious effort as a team or just you as an individual?
There is never an individual contribution, right? There is it's always a team effort. There is maybe individual ideas, but execution is always a team effort.
And so you've put on a lot of effort, and then we can go back to how we leverage this for the right intentions. How does that look like in real life? I'm always curious, and there's a lot of people also asking me is how much of this is time being parked and going against your nature, which creates friction and requires even more energy. It is energy draining to be out there and then completely using a megaphone and then trying to play with the algorithm, which requires quantity over quality. I mean, it's a bit ridiculous the way it's structured. Unfortunately, we have to use the tools that are available at our disposal. How much? What does it look like in anything you can speak about in the deal life?
I read someone that a famous contributor on LinkedIn, very successful, that said that he's doing it over breakfast, 5 minutes, just takes over breakfast with a coffee, posting something. Mm-hmm. Chapeau. For me, it's taking way longer.
Yes.
And it's unpredictable. You may have this idea and then it will take you 10 minutes to post and you will get 2,000 likes. And then there is something that I will work on for 2 weeks. And then when I post it, it's going to be, I don't know,
a total
80.
Flop, right?
A total flop.
I mean, yeah.
Yeah. There is no way to predict what on a certain date, on a certain time that is going to be successful. What is important is consistency. Mm-hmm. So it is important that we try to understand what is it that our audience is interested in and try to create quality content for that audience. So for myself, for example, I'm doing less on the quantity, but when I do something, I'm trying to do something that is new, to mm-hmm. bring a new idea, a new thought, something I've learned, something I've observed, that when my audience is reading that, is like, yeah, we can relate to that. Oh, this is a contributing. Yeah. So I like the comments. I learn from the comments. The comments are giving me ideas to learn, to get better, to post on something that the audience is interested in. But it's definitely not something that is taking me 5 minutes over breakfast. In fact, we have our own editorial meetings and plan things sometimes months in advance.
So does that mean that you have a team? Do you externalize any of it? Or it's purely a time card from your schedule that you book on certain blocks?
Of course, it's also for my schedule, but if I need graphics, sometimes I can highly recommend Canva. Big fan. I'm using it a lot myself, but sometimes it's beyond my skills, and then I would need help, right? Things like that.
And there's something to be said about the fact that you're an introvert. I'm glad that we're breaking that myth that only extroverted people that feel very comfortable by nature would do such things. I'm also an introvert. I used to be extremely shy as a kid, and it took me 12 years to post anything on LinkedIn. People tend to forget that. It seems like it's something, all right, they just get it. And I invite everyone to sort of push their limit, particularly founders, but also investors, and that's kind of the new trend here. And maybe I want to emphasize the fact that Andreessen Horowitz, A16Z, built a moat, right? Built an enormous successful brand, and they were the first to do so in Silicon Valley. Then you have also big names like Fred Wilson from Union Square Ventures and the likes, and they first understood the different channels that were necessary to grow their portfolio, to attract deal flow, but also attract LPs. And we have less. So I'm not aware of any top brands like this that have a global reach in Europe. So there's a bit of a deficit here, and we need to work on it.
When we started, we said we want to be the A16Z for climate. And what we meant by that was exactly on that piece of content. Mm-hmm. Basically, that we want to share, because there is a lot of, we are going in an uncharted territory here. We're writing the playbooks in many of the things that we're doing. And therefore, there is a lot of knowledge. And I think it's important that we share that knowledge. And we're not giving away our IP. We know how to do things, and doing things is really what you master. But just sharing knowledge is not giving away any secrets. But at the same time, one, it makes everybody better. Mm-hmm. All boats are rising. And at the same time, it puts I don't know if it's a brand, but building, but people understand what you stand for. What is it that you're working on? What is it that you stand for? How do you think? So it makes our discussions and the people that come to us way more easy, because people know what we stand for.
And you're right that we're trailblazing many paths: the FOAK path, the brand building path, the regulatory path, investing in new technologies, but so did the original VCs, right? You were talking about what happened before software, the Fairchild, semiconductor companies. This is all they did, right? Silicon Valley was built on wave after wave after wave of innovation, and you need to innovate on so many of a stack. And so I'm very glad that we're doing this. Are you inviting more people to take that risk and to sort of apply that to themselves? Or do you think it's going to turn the net positive into a bit of a zero-sum game? Some will compete on the brand, and then it might create too much noise.
I think that each one is choosing their own path. For some, it's better to go on LinkedIn. For some, it's or Medium. Some, it's better to have their own blog. For some, they have more conferences that they're going to. For some, it's a podcast. Or if some have their own WhatsApp groups. So I think what is important is that whatever you choose to do is, and this is what differentiates the real ones from the copycats, so to speak, is that it has to be authentic. Mm-hmm. We were talking internally, should we do Instagram? Should we do or an X? Yeah? So mm-hmm. We're not on X. Is it good or bad? I don't know. On Twitter, yeah. But it's not me. I'm not the guy to write 140 characters and tweet. That's not what I like doing. I don't feel comfortable. And if I have to open up a channel now, it would not be myself. It would not be authentic. So we decided not to go on that channel. Maybe we're missing out on something, but it has to be authentic.
We're talking about authenticity. So I'm very glad that you're bringing this up. The LinkedIn it caters to a particular audience. It's still on the professional side. It's they call it 25 to 45. Mainly the Western world, because if you travel to
Right.
on Southeast Asia or Africa, you might not see as much of a. So should we also venture to territories that are uncharted yet? So, for example, TikTok, or you mentioned Instagram, but TikTok is a particular one where it caters to a completely different audience. And then maybe what we have to say to inspire people on the innovation, on the solutions that are available to fight climate change should be relayed with the megaphones on those channels. Or should we stick to a little group, right, that is already kind of convinced, but it might create an echo chamber where we convince each other on the way to proceed, but that excludes 90% of the world?
Generally, I'm all in favor to go out of comfort zone and go beyond and not just do what you know, right? At the same time, it's also a matter of resources. So what is the possibility? What can you do? And we had a lot of ideas to do about how to do 20 seconds videos, and maybe it fits the TikTok.
Yeah.
We didn't get to it. Yeah.
Do you have any role models in VC that you're looking up to?
Oh, for sure. So I can always mention my mentors, Chris Russ, and then Rajiv Maidhaven from Clear Ventures, coming from the Silicon Valley. They come with a pedigree of growing up either in Chris in Sequoia and Rajiv as an entrepreneur. They are my mentors. And when I look up to how things are being done in the VC game, I look up to them.
Do you have any sources of information? So you were kind of mentioning off the record that parking out 40 minutes, an hour of your time to listen to a podcast is really, really difficult. People, and I've learned that, consume content in a very different manner. Today, the attention span is so reduced that shorts on YouTube, on LinkedIn, video-based, tend to strike the right. But is this enough? Is this enough to just plant a seed to then push you to sort of explore further? Or do you have other content channels that really, really work for you?
I think what's important is, at the end of the day, you kind of read the same newspaper always. So the question is, how are you exposed to news and things that are going on which are not the usual? Yeah. So I'm always opening up TechCrunch, etc. Right. So what we try to do is internally on Slack, we have this news channel that everybody is posting stuff that they read. So all of a sudden, it's not just myself that is reading stuff and sharing, but also other people reading other sources in different languages and posting those. And then, okay, you're being exposed to other things that you didn't run into. Myself, I also like interesting engineering on Instagram. That's a great one.
That's a good one.
That's summarizing the wonders of chemistry. That's another one that I get a lot of their stuff, and I see things that I'm not exposed to otherwise in the daily job.
And it's great that you're mentioning this. So I also go binge on YouTube, for example. So whenever I receive a deck from a completely never heard of technology, the first thing I do generally is to go on YouTube and then try to binge on all the tutorials or videos or anything like this that has been made, right? It's sort of to plant that, or to lay the first layer on which on top I can build my little castle of knowledge. Because at the end of the day, we are pattern recognition machines. So we are trying to build those layers. But the first layer often is YouTube for me. And then comes the conversations I have with my fellow investors, the founder, the reference calls. Do you also use YouTube for that matter?
I use YouTube. I use also to read articles, what has been published on the topic, academic papers, to see what was the state of the art. This is maybe a good segue to the topic of pitching. And I think that most of the founders are missing out on what really matters for me. So maybe others are something different. For me, what really matters is usually, if it's a 20 slide pitch, usually my slide, the one I'm interested in, is somewhere around 17, 18. And that is the competition. Or let's put it that way, the landscape. What I'm interested in is not in your product per se. I'm interested, how do you blend in? Where is your place in the universe? Where is it? There has been things out there all the time. There has been things, technologies, you can go on YouTube, you can see the state of the art technologies. How is it that what you're doing at this point in time is significantly different than what everybody else is doing? And that is the one thing that really matters. How is it 90% cheaper? How is it 100% faster, easier to scale? It all boils down at the end for dollars signed, but that is what really, really matters. Less of, hey, we are doing electrolyzer that has this type of catalysis material, catalyzers, etc., etc. That doesn't matter. What matters is that why has the universe been waiting for it? And why now? And usually this comes in slide 18. Because when that's exactly to your point, when we're gonna research about the company, where are we gonna start? We're going to start in YouTube and seeing what's the state of the art of technology. So we have to understand how this is different to what is already out there.
Right. And it's so understated, particularly in Europe, the importance of storytelling in pitching, in climate tech. And I cannot emphasize this enough. I get frustrated to the point where you anticipate who's going to be a zombie. Zombie land is waiting for you. If you do not manage to strike, and there are 3 key points for me. Number 1 is the market needs to be ginormous. It is a venture. If it's a venture-backed business, that means we need a $1 billion exit. Otherwise, the economics won't work for us, which means that it cannot just take 5% of a new industry if the industry is too small. It has to take enormous market share away from the incumbents and then transform, take a quarter of humanity with it. Think of Airbnb, think of Uber, think of Twitter, think of all the companies that have become enormous successes because they transform habits. The second one is the founders need to be completely exceptional in their capacity to tell the story. And the story not in this is what we're working on, the labs and the technical details. No, it's we're coming back from the future and this is how it's going to roll out. This is what's going to happen in the next 5 years, in the next 10 years, in the next 15. And it's unstoppable.
Right.
And we're the right team to make this happen.
Right.
And the third one is the competitive landscape. This is, okay, there might be other players out there, which is a great signal, by the way. VCs are not against competition. They just need to know what's the differentiation. So differentiation is everything. How do you differentiate on the technology? How do you differentiate on the go-to-market? How do you differentiate in who you're going to hire to make it happen? How do you differentiate in terms of brand? And then how do you turn this into a category of one? You need to build a new category in this enormous field because that's the only way you're going to attract top VC dollars and a ton of financing and the greatest talent, and you're going to win this war. And the storytelling is just such a deficit. It should be more taught. There should be more courses. There should be more content. And I don't really know how to, especially those brilliant technical founders, to take them out of their labs so they can take those courses of realize the importance of not having this. They're wasting their time. 90% of VCs will just turn them down because they haven't cracked this. It saddens me because they will be the zombies later on, right? Working for 4 years into a project, not going anywhere because they haven't found that product market founder fit yet?
Look, I think it goes back to, I think that in business school, there was too much business and too less of social responsibility and stuff. And at the same time, I think that in engineering school, and nobody's perfect, I'm also an engineer. I went to engineering school. I barely learned any business. So reading P&L and understanding things I had to do on the job and later on. And when I wanted to study business, I had to bring a letter of recommendation from my previous university, from my professor. And he was like, why are you wasting your time? I don't know if I want to sign this. You should become a brilliant engineer. But I didn't. But it's not being taught, right? And when we're talking to the engineers, it's great that, or scientists, it's great that they have this new way to replace Haber-Bosch with green ammonia, synthetic ammonia way to do things. But if it's just 10% improvement of the previous process, then no incumbent that spent billions in CapEx is gonna change the process if it's not a drop-in solution. So you have to think in a business-wise. Another example, if you're, who's your exit channel? Who's going to buy you? Who's going to buy this technology? How you're going to actually exit this? And doing SPAC is not the right answer. Yeah, it might have been 2 years ago, but that's not the right answer. And you have to think of, this infrastructure is going to buy us. Yeah, but you know that this infrastructure company is being traded at 1x revenue. So they're not going to buy you for more than that. That means that if you want to get to $1 billion exit, you have to generate revenue in $1 billion. This is not SAP. SAP just bought a company for 4x, for over $1 billion, with over 4x on the revenue, because they are themselves being traded like that. Yeah, so this is the challenge also that we have in our sector.
And it's good that you're bringing up the exit path, because it used to be taboo. And there is also a fact that because it is impact, you should create a perpetual business and you should remain the CEO, should remain in control of your business, because that's the only way that you can be the preserver of the values of the business. But the truth is, the same way strategic coming back in the equation, on the cap table, because they're the ones that will enable you with an offtake agreement to implement and diffuse the technology. I don't see any other way around today to scale globally your technology without an exit. There's got to be IPOs for sure, because you're going to be so transformative that you're going to create a new habit and transform the industry or create new industries from scratch. But the majority will be bought out by Siemens, by Bayer, by Volkswagen, by Schneider Electric, because they already have the networks across 6 continents, and they have the ability to build factories, and then they have all the suppliers to diffuse that innovation that gonna cut down 50% of the emissions. So it should really be lifted as a taboo. And you should, when you engage with VCs, you should really say, we're going to be bought up. And this is the very likely scenario. And by the way, this is the top prospect that we have in mind, and we're already in conversation with them.
Exactly. And I think that we're all here to do good, and to save the planet. And this is why we do what we do, and why we started doing what we're doing for the first place. But let's not be mistaken. We are here to make money. If you're in a VC game, you have to make money. And by the way, we strongly believe that saving the planet is good business. Yes. Mm-hmm. So if you're not going to make money, you're not going to save the planet. So this is not either or, but at the same time, there is sometimes too much glorification of the doing good, impact, and we're here for saving the planet, so we don't necessarily have to make money. No, that's not the case.
It's not contradictory. And if money is a proxy of exchanging goods, right, and good exchanges, the money here is just a stamp that your project is going in the right direction.
Exactly.
It's society rewarding you for something that it doesn't know how to get.
At the end of the day, we're talking about trillion-dollar industries, oil and gas. They're making a lot of money. They need to change. In that process of changing, we're going to make a lot of money. And only by doing so, they will change. It's all about the money. That's how it is. That's how things work. But it's not contradictory to the fact that on that journey, we're going to do good. There is no such thing as a green premium because people are not willing to pay green premium. People are not paying premiums for commodities. People are not going to buy. If there are two apples and one is costs high and the other is it's green but the other is cheap, people are not going to buy it. Oh, well, maybe here in Berlin, hipster land. But we're not going to change the world. It has to be on par. And when it's on par and it's green, that's when we're going to make the revolution.
Hey. Well, thank you so much, Yair. We've been going on for a while. Thank you so much. There's so many topics that we could explore, maybe on round 2 someday.
Sounds like fun. Thanks for having me.
Thanks so much. Ready to make a substantial impact on our planet's future? Join the Climate Insiders community today. We are a group of investors committed to supporting bold, moonshot startups that are tackling climate change head-on. Become part of a new generation of climate investors and help us create a sustainable future. Visit climateinsiders.com to join now.